Now, income smoothing is, in my opinion, one of the largest benefits to realtors. My name is Andrew Wall, and I'm the managing partner here at CPA for IT. And it's not something that you're probably going to see discussed anywhere. And I had to sort of Google a definition for this presentation, because we always have notes that go along with this. And so anyone who wants a copy of the PowerPoint deck, every slide will have some additional notes beyond, of course, what I'm sharing with you today. So they say basically income smoothing is an umbrella term for the various techniques and methods used by accountants and financial experts for controlling or hedging the effects of high rises and sharp falls in corporate income. As is commonly used, income smoothing is often associated with clever manipulations of income or profit, creative accounting techniques, and the application of general accepted accounting principles. However, real practice income smoothing goes beyond these. It encompasses all strategies used in hedging and against high expenditures or costs and increasing business earnings. Oh, this is a mouthful, right? What does it basically mean? So there's two types of income smoothing. We can smooth income for the corporation, and we can smooth income for the owner managers or the employees that we're remunerating out of the corporation. So really the big benefit is out of the income smoothing to the individual realtor. And by this, what I'm talking about is the personal salary that you're going to receive from your personal real estate corporation, whether that is a dividend or a salary. What happens in Canada is we have a marginal tax system. So we have different tiers, right? And the tax in the different tiers is taxed at different amounts. And as you go up those tiers, the amount gets higher and higher and higher, all the way up to 53.53%. So as a result of that marginal tax system, if we were to have, let's say, 2 years of $60,000 of income versus 1 year of $20,000 and 1 year of $100,000, the combination of those 2 years of 20 and 100 is going to pay more tax because of the peaks and valleys than the 2 years of 60. So if we can smooth income and make it more equal and avoid these peaks and valleys that happen, quite frankly, with realtors. I mean, obviously, sometimes commissions can be large. We're selling our office building right now in downtown Toronto. It's listed at $5.5 million. So you can imagine the commission on that. That's going to make a nice little chunk of change for someone. But those sometimes, that has been on the market for a little while. It's probably going to be on the market for a little while longer. Those deals don't close overnight, right? So as a result, we end up with these peaks and valleys, and they don't often close on December 31st just so you can get your income in, right? These things are going to be elapsed over long periods of time. But if we have the ability to control when we take our income and how we take that income, that gives us the ability to smooth these peaks and valleys that realtors often go through. And like I said, this one person I was talking to, they didn't think a prec worked for them, and they were a perfect example of peaks and valleys. So a small loss in 1 year and then a $200,000 gain in the next. That is a perfect example. In that individual situation, there was literally a $12,000 benefit to being able to smooth that income. So there are very, very significant advantages to smoothing income. And it is a perfectly legitimate and reasonable tax strategy. Now, of course, accountants, as many tricks up our sleeve as we may have, there are limitations to what we do. So it all depends on your personal situation.